All right, guys. Make sure my sound is working. It's the FOMC meeting today. Honestly, a huge day. We got Meta earnings afterwards as well, so we're going to cover all of that. Here, bear with me, chat. I just got to get these headphones hooked up, and we'll get there. There we go. All right, we're in there. All right, guys. So the FOMC meeting today, absolutely huge report. You can see the Nasdaq and Nvidia both very bullish today because of this. You can check it out here. Look how much strength the Nasdaq is showing, mostly driven again by Nvidia here. FOMC meeting starts. The Federal Reserve is most likely going to pause rates today. It's very, very, very unlikely we're going to cut rates. I think the CME Watch tool gives it about a 4% chance of an actual cut. A 4% chance, which is highly improbable, right? It doesn't mean it's not going to happen. Anything could ultimately happen here today. And so it doesn't mean it's not going to happen. Anything could happen. The Fed can decide to do whatever they want to do. But it's just super unlikely that we're going to cut rates today. It's just not very probable. A cut would be a desperate decision, I would say. I don't know about just maybe one cut, but cutting more than once this year would seem a little bit more desperate. And I think if the economic data looks worse, fine. But if the economic data is good and we have good jobs, good labor, low unemployment, I don't think a cut is something that we should do at all. I think we should avoid a cut at all costs if possible and really combat inflation by maintaining a high interest rate environment. That's what I personally think. I think real estate can handle a correction. It's up like 100% over the last few years. And so a correction is almost necessary, and lowering interest rates and adding more buyers, I just don't think that's going to help. I think that's going to make prices go up, not down. I think inflation's going to spike, and ultimately, we'll see what happens. The Fed is the ultimate decider there, and I'm not sure, again, what they're going to do. I just hope they have some logic. And, it is an election year. Historically, there's more pressure to cut during election years. And we also typically get a pretty strong market. You can see Nvidia all the way up at 115s here, chat. 115s. So, again, let me know what you guys think. The FOMC decision will be at... happens at 2 p.m. Eastern Standard Time, and we'll be live on this stream. 97% likelihood of another pause. We will also stream the full press conference with Powell. Subscribe for more economic content. All right, guys. I'm looking forward to Roblox Carvana earnings after the bell. No cuts, but the Fed says they are making excellent progress. This will pump the market, my guess. Jerome Powell at 2:30, yes, sir. And again, we'll see what happens. Very unlikely we cut today. Highly probable we do another pause. The cut will probably happen next month, and at least 100% of people on the CME Watch tool think that we're going to cut next, not next month, but the month after next in September. So 90 or 100% of people in analysts there think that we're going to cut starting in September, not today. 97% of analysts don't think we're going to cut today. So we will see. Again, Nvidia, very strong today. If you heard me this morning, I thought we would have a choppy day. I definitely didn't think Put that scroller on the bottom. I'm looking forward to Roblox Carvana earnings today. They miss. Great recovery with Nvidia. Yes, sir. Again, Q is strong. Anything else? I'm going to put gold up. So we're going to put Nvidia. A deep look at tech. And then gold, which looks to be spiking up again today. Gold is close to the lifetime highs. The lifetime highs for gold are right here where this light blue line is. That light blue line is the all-time highs for gold. So yeah, we'll see if we get anything good there. I'm waiting. They fixed the layout a little bit. There we go. Jobs are strong. Fed said labor is strong. We can leave rates higher. He continues to say this. Right. Okay, so let me explain the more, the nuances of rate decisions. Okay, so number one, Powell is going to be getting political pressure to cut. Now, of course, he's going to say, oh, well, I don't listen to them. And maybe he doesn't. I don't know. I don't know Powell. I don't know what his thoughts are outside of his public statements. But he says he's not going to let politics influence rate decisions. Generally speaking, looking back at history, it does influence rate decisions. And so I think he's getting a lot of pressure to cut rates to stimulate the economy, to protect us from, the negative consequences of a high interest rate environment. Like, eventually it's kind of like picking up pennies in front of a trade track. If you keep it too high for too long, you will break things. And I don't think we've been high for long enough, though. I think inflation is the way in which the economy is going to break. Not necessarily a recession or both in stagflation. A recession is not the big risks right now. I think the big risks are inflation spiking up again. Interest rates aren't even super high looking back over the last couple decades. Interest rates, like if we look at the history of the federal funds rate, this is the easy way to look at it. Here's the history of the federal funds rate. Interest rates, if we look at a chart, here's the 1980s. Imagine right now everybody's upset about, a 6% interest rate. Thank you, baby. Imagine if we had freaking 19% short-term interest rates. Imagine what mortgages would be like. It would be a disaster. And so, if we were in some type of 15, 10%, 15%, 20% interest rate environment, that would be completely different. And that's understandable to get pressure. As well as like if we saw consistent less jobs openings, like less economic growth, less job openings, losing GDP, unemployment over 5%. Those are kind of the signs of a recession looming, and we don't have that. The yield curve is inverted. To kind of look at both sides, the yield curve is inverted still, but it's getting closer to neutral. And right now, again, we're in a situation where the last few years have been mostly restrictive monetary policy, and we're starting to see some damage to inflation, but it's not a perfect science. I'm worried about inflation spiking, and I think prices have gone up a lot for the last few years, and so I just don't think the country wants higher prices, which is what a low interest rate environment is going to give us, But we'll see. We'll see what happens. Nobody knows. We'll see what the Fed decides to do. I'm eating some Alfredo chicken. Guys, some Alfredo chicken. All right, so my wife made me some tea. Shout out to Carol. NASDAQ, Nvidia still looking very, very strong. Gold's still close to highs. Somebody said over an hour till the report and you're streaming already. Yeah, I mean, listen. We're covering the action leading up to the report. the report, and then the following price action we get after the report. This is what we always do. And then Meta earnings later today. There's some people that stream all day. I don't see a point in that. There's too much times in which nothing's going on. I would rather just stream the big events of the day. You know, it makes more sense for my own personality. And apparently, since, you know, our views are pretty solid for this report, a lot of people at home feel the same way, you know. My guy is just upset, man. Cheers to you. Carol does save the day. I feel like I know who just said that. I feel like I know who the crypto guy might actually be in real life. Somebody that is probably not that happy about a high interest rate environment. People are weird, dude. You realize people are weird. But they're predictable, I think. Anyways. Hey, all good. No worries, Corey. I appreciate it. Larry says, I don't know if I want rates going up or down. I mean, here's the thing. What do you care about more? Prices going up too much or buying a home right now? You know, a large majority of people are going to say prices going up too much. Prices going up too much is going to make problems worse. And if we spike inflation just to pander to real estate people, it's just going to make the situation worse again. And what this means is that if the U.S. wants rates to be, you know, stabilized, if U.S. wants stabilization in rates, if I want to use big words, what we're going to have to endure is, you know, a little bit of time in which it's not the most optimum real estate scenario. We're going to have problems in real estate while it corrects, and real estate can handle those problems. Again, real estate is up 100% on the year, or 100% over the last 4 or 5 years. So it can handle the correction. Stock market's still at highs. The labor market's still pretty strong. Unemployment's under 4.5%. You know, I just don't see a need to cut rates right now. But again, it's an election year. They're going to have political pressure, so we'll see. Price, yeah. LUN about to rock it, yeah. Y'all remind me to switch my headphones out. Big Papa Powell. Let me get a timer up. I haven't done a timer yet. All right, so here's the timer. We have 49 minutes until the rate decision. 49 decisions. Did we do a poll yet? I did not. Does the FOMC cut rates today? Yes or no? Vote on the poll. What color will Powell's tie be? FOMC is at 2 a.m. Right? It's at 2 p.m. Eastern Standard Time is what it is. You know. Nvidia is, again, the big story of the day, Chad, in the stock market is Nvidia. Nvidia up to 116.50s. A very strong, very clean rebound, right at $100. You know, we talked about the $100 psychological level, and Nvidia went basically right down to it, within a range of it, and then bounced directly off of it. Now, there's a lot of ways you could look at Nvidia. Okay, so here is a zoomed-in look. Short term, let's go over the different potential trends we might have. Short term, I think we have to call a spade and show that Nvidia is downtrending over the past. Let me clear some of these levels out. I think Nvidia is downtrending if you put up a yearly chart and zoom in. I think here's the downtrend. I think it's pretty clean downtrend, pretty obvious downtrend here. On a daily chart, I think that's obviously what we have is a pretty obvious downward trend for Nvidia. And this is what's ultimately dragging the market down. When we zoom out a little bit more, though, we have a very clear trend. If you put a weekly chart up, You know, for Nvidia at least, we have a somewhat of a trend like this, but I think this one's a little iffy. Definitely a strong upward trend, like long term, but it seems to be expanding as well. So I don't know. I think if you look at something like the SPY, you know, the S&P and the NASDAQ, mostly from Nvidia, are very volatile in that way. And I think this might be kind of the start of a trend, but again, it does look like it's expanding. If you look at the QQQ here, here's the NASDAQ. NASDAQ's got a really clean trend too. I mean, very obvious long-term trend. And so looking at most trends here, everything's mostly bullish. You know, if you zoom in super closely, Nvidia shorter term is definitely bearish, definitely correcting. Nvidia relative to highs is at, let's see. So Nvidia relative to highs is at, where was highs on Nvidia? Gold at lifetime highs. Gold's definitely, Nvidia was at 140 at the highs. You know, it dipped as low as 103. So Nvidia fell 26.5%, a very large, lost over a quarter of its value in terms of stock price. But now it's at 115. So now relative to highs, it is down about 18%, about 18% down from highs. So the question is, how big is the correction? Is it time to buy the dip? I don't know. I'm waiting, you know. I don't think now's a time. I don't think now's a bad time personally, and I'm going to preface it with I'm not an investment or economic professional. I'm not liable if you lose. I have no idea what you should do. I might be wildly wrong about anything and everything I say. But with that said, I think now might not be a bad time. If we're talking about index funds to kind of increase the DCAing a little bit more, like start dollar cost averaging into maybe some stocks, maybe some index funds, blue chips specifically. I know like today the Russell is losing value. Small cap land is losing some value, but honestly the Russell's still pretty strong. Honestly, I thought it would be losing value today. I spoke before I really looked at the chart. I assumed it was moving inversely to the markets, but the Russell's still very strong, honestly. And the Russell is getting close to lifetime highs. Lifetime highs for the Russell are 2,300, roughly 2,300. A little bit, or no, I'm sorry, about 2,500. So we still got a ways. Nvidia tested highs again. Bearish. I need to buy more shares of Nvidia, so I love Nvidia. Gold, I feel like we're going higher. Yeah, gold looks strong. Gold in terms of lifetime highs is very, very close. Lifetime highs on gold are about 24.80s an ounce. It's at 24.873 right now. So gold is close. And gold looks like it's about to break highs. The interesting thing about gold is that it's a powerful inflation hedge long term, but there's also risks holding it like super long term as well. Super long term's fine, but medium term it can downtrend for long periods of time, like years. And so that the risk of buying gold is that you might buy it and have to sit on it long term. What do you guys think of gold? Are you bullish or bearish short term? Bearish. So the actual press conference is at 2:30. The FOMC decision is at 2 p.m. So the way it goes is 2 p.m. Eastern Standard Time, the FOMC announces their rate decision. It's almost certainly going to be a pause. We've got about a 3 or 4% chance of a cut today. So not very likely, not very probable. Most likely going to pause rates. Following that, we're going to have the press conference at 2:30, the accompanying press conference. And that's when we're going to have, throughout this thing, we're going to have thousands of people here watching. LUMN. Yes, penny stock running up. Should I put the dollar index up here? So here's the Dixie. The dollar index spiking pretty big at 104s. Interesting. A lot of stuff's moving up. Q is moving up as well. Gold is like the Bitcoin of metals. Yeah, maybe. Looking at our votes here, most people are smart. 40% of people saying yes, we cut rates, which I think is crazy. I think it's super unlikely that we cut rates. Very unlikely. Again, I'm not saying it's not going to happen. There's a chance. Like, there's a small chance that it happens. But yeah. Because of elections, yeah. Sorry, I'm new, but will it go high if they cut rates? We don't know. This is super up in the air. It could, it might not. We'll see. Also, do me a favor, bump that like button if you haven't already, chat. Let's try to get over 100 if we can. It's the tipping of the cup moment, maybe. I know right now we're in the middle of summer. A lot of people are gone. A lot of people are traveling. It's July. Everybody's on vacation. July 4th is coming up. Or no, I'm sorry. August is coming up, the end of July. And so, you know, we got some time, but summer's ending. School's going to be starting. More people are going to be interested in the market when that happens. Hey, thank you. I appreciate it. Yeah, we'll see what that looks like, though. Again, we'll see. We still got 40 minutes before the FOMC decisions here, so we got time. I'll hold gold for 10 to 20 years and sell it. Yeah, good luck. I hope you do. 250 by the end of the week? What's 250? Why did the indexes move 600 points overnight? I'm not sure. I think Microsoft earnings might have influenced it. We had MSFT earnings, Google earnings over the last week. Yesterday, we also had AMD earnings, which most microchip stocks are benefiting except for AMD. AMD is actually down a significant amount. MU is pretty strong, though. We're in MU. My portfolio is actually very green. I didn't even look at it. There we go. We're still in Microsoft. Meta's green. Honeywell's green. PayPal's very green. Treasury bill's green. A lot of stuff's green today. Tesla. Honeywell. Intel. Meta. Microsoft. MU. Nike. Nvidia. Pfizer. A lot of stuff's green today. PayPal. I think Microsoft's going to 410. Yeah, I bought Microsoft. I bought Microsoft after the gap down from earnings. So after the gap down from earnings, I bought it and wrote it up really nicely overnight. A lot of stuff just flew, to be honest here, man. A lot of stuff ran big. Powell will pump for August, then we have bear months for September and a half of October. Maybe. We'll see. All right, guys, there's the Q at 470s, the dollar index at 104.20s. Again, so I'm going to go ahead and state everybody. So for everybody that doesn't know what this is, today is the FOMC rate decision. If you don't know what this is, right, the FOMC is basically the bank that creates policies and you know, supports other banks, right? It's called the Federal Reserve. It's not technically a government entity, but its job nationwide is to support and create policy to influence banking. What the Federal Reserve does to control interest rates, or what the Federal Reserve does and what their job is to keep a balanced economy, right? They don't want it too strong because when the economy's too strong and inflation spikes, people are unhappy. If too little people are working and spending and we go into a recession, which is the other side, people are unhappy. And so their job is to keep it balanced somewhere in the middle. What you see a lot of the time during massive economic, you know, crashes, recessions, depressions, is you see the Federal Reserve step in and take what's called monetary policy, a dovish stance. What this means is that they're less restrictive in terms of monetary policy, meaning they can allow interest rates to go down and allow people to get really cheap access to money and lending and loans through mortgages and real estate. A lot of people benefit from that. But again, if interest rates are too low and people are spending less money on their mortgages and car loans and stuff like that, they're going to have more money to spend. And so inflation can spike because of increased spending amounts, right? So they're keeping it balanced. During economic weaknesses, the Fed will cut rates. They'll try to bring interest rates down through a couple different ways. The main way is just by lowering short-term interest rates. By lowering short-term interest rates, eventually it trickles into long-term interest rates, and it influences interest. So when people are paying less money, if we're about to hit a recession or depression and the Federal Reserve lowers interest rates, this allows more people to work, more people to spend, people have cheaper access to lending, and it ultimately stimulates the economy. They can do a more desperate move, aside from just straight up cutting rates. They can do what's called quantitative easing, which is a form of money printing where they create bank reserves and then they use those to inject liquidity into those markets through banking, through bond and financial asset purchases. So they buy up a bunch of bonds. This injects liquidity into those markets and allows banks and institutions to lower interest rates to consumers. This increases spending drastically. But again, if you keep it like that for too long, inflation spikes. If inflation spikes, they have to play the other side of it, which, again, the other side of it is what's called a hawkish Fed. A Fed that wants to keep interest rates high and really kind of push down the economy, push down spending a little bit to control inflation. Because when you raise interest rates to consumers, they're going to have less money to spend, and so they're going to stop spending as much. They're going to stop. Lending dries up, and so people have less money to spend on things, right? And so, again, that's a restrictive monetary policy. But if you keep it high for too long in that side, recessions, depressions happen, right? So the game is playing it somewhere in the middle. During 2020 and the pandemic, the Fed cut interest rates almost to zero, and they kept them there for years. They also did quantitative easing. They also sent out stimulus checks. All of these increased spending dramatically, and it kind of saved us from the, big, deep recession that a lot of people expected. But the consequence was inflation spiking up to 10%. And so now the Fed, over the past few years, has taken a hawkish stance. They've taken what's called a restrictive monetary policy, in which they've pushed interest rates higher. I'm not even going to say interest rates are high right now, but they are higher than they have been for the last couple decades. They were at 7-8%. That's why you're paying so much interest right now if you want to buy a car or if you want to buy a house, And so a lot of people are pushing for rate cuts. They raised interest rates through rate hikes for years, and then they've maintained these high interest rates over the past year straight through what's called a pause in the federal funds rate, which means that they are pausing rate movement. They're not raising rates, they're not cutting rates, they're keeping it flat. If you look at the federal funds graph, if you look at a Fed funds graph and you look at the last 5 years, here's 2020. They brought rates down to almost zero and they maintained them there. And then they did a bunch of rate hikes, and now they've been pausing rates for some time, so they've been pausing rates up here for some time now. So again, we'll see what happens. We're right here. They're pausing rates they've been pausing high rates for the last year straight, and a lot of people are pushing for rate cuts. So now the big question is, are we going to cut rates? I don't think we should. I hope not. It's going to make the problem worse. And again, I hope, I hope it helps. I hope we pause rates. Most likely, if you look at the likelihood of rates right now, again, 98% of people expecting a pause, 2% of people expecting a cut today. It's not impossible. They can do something outside expected numbers like this. It's just less likely. It's less probable. If you look at this here, again, 90% of people expect a 25 basis point cut in September. 10% of people expect a 25 basis cut in September. 10% of people expect a 50 basis point cut, and 0.2% of people expect a 75 basis point cut. Again, pretty likely that we're going to cut in September, but if Powell can change these percentages very easily. So Powell can influence these heavily and change these fast, right? And so that's what you want to understand. Powell can and will influence these probabilities, I should say. So again, we'll see what happens. What do you guys think? Looking at the polls, you know, we still got like 40% of people expecting a cut, which is crazy. Crazy. It's super unlikely. I don't know what's going to happen, but it's super unlikely, you know. There was a spike in volume on Apple. Looks like volatility ahead. Surprise cut. So that's obviously bad for the US dollar, but the cut will support gold. Rates equal heavy red candles for gold. Maybe. You ready for me, John? What's up, Crash? I trust my crystal ball. What's up, Mark? Wiles, then they'll have to raise rates extremely next year. Maybe. Anyone else having problem understanding bullish movement? I have to keep the chart both right way and the second one upside down under it to see it from the bearish angle. I'm not sure what you mean there, Lil. They will, but they probably shouldn't. Yeah, they're going to cut next in a month and a half from now. This happens every 6 weeks, but they probably shouldn't. I agree. I think we'll reach that gap on the E-mini future chart and get rejected hard. Where'd he go? Where'd who go? What does no cut mean for large cap tech stocks? Not being on it. I mean, it cuts on the table about 3% of people. Yes, but the market just turned a little bit. Again, a lot of this is driven by like Nvidia, to be honest. So like here's Nvidia right here. A lot of this is driven by Nvidia. You know, Nvidia at 116s. So Nvidia is the single biggest stock influence over the market, and it's not even close right now. Apple still has some influence. Tesla still has some influence. Like if Apple or Tesla drop 15% quickly, it's probably dragging the market down a little bit. But nothing has the type of influence right now over markets than Nvidia. Nvidia has the largest influence, and again, it's not even close. Nvidia can almost be seen as another stock market ETF right now, because Nvidia has so much weight on the market. Like, look, here's the S&P 500 chart on the SPY on the left side, right? Here's the S&P, and then here is Nvidia. So Nvidia just has such a big influence right now, such a massive influence that, yeah. We'll see. But again, the SPY's trying. The SPY is at 550s right now. But a lot of it is just following Nvidia closely. Like if Nvidia falls, SPY falls, and vice versa. So again, we'll see, but not even close, you know. I agree that he will say something very positive to have a green August. I think he's going to be, a lot of people sided with me. I think he's going to be more restrictive in his mind. I think he's either going to pause today but have a dovish stance, signaling he's going to do a cut in September to go with the probabilities, or I think he's going to stay very neutral and then cut anyway in September is what I think, you know. But again, if he comes out being super pessimistic about rates and inflation specifically, like you want to listen for inflation, because inflation is what is going to signal rate cuts not happening. So if inflation spikes, if Powell is super worried about inflation, he might not cut in September. He might cut later than that. But right now, most analysts are expecting a cut in 6 weeks. So in September, these rate decisions happen every 6 weeks. And so most people are expecting a cut then, you know. Can we use the past two FOMC meetings as an idea? The past two Nvidia has rose slightly, maybe a silly way to think about it. I mean, there's a lot of correlations. You don't want to get too wrapped up in correlations, though, because there's a very famous movie about a guy trying to find the best stock market algorithm and find all the different patterns in the stock market, and he eventually went crazy. It's a 90s movie. I can't remember what it is. So you don't want to see too many correlations, and correlation doesn't always mean causation. You know, there's a positive correlation of people falling in pools to Nicolas Cage movies. You know, so correlation doesn't always equal causation. Anyways, the SPY turning back down, had a very green opening bell, and now it's coming back down. Nvidia back down to 115s almost. So a pause, then hawkish. I don't know. I hope that's what happens, Jamal. I really do. I hope we pause and we're hawkish, and it doesn't sound like we're going to cut rates in September. I'm just not confident that that's going to happen. I think it's pretty probable that we're going to cut in September, unfortunately. And so that means that, you know, interest rates are going to drop, inflation risks are there. But, you know, U.S. paying over $1 trillion in interest on debt. No cut before March of 2025. I hope you're right, Danish. I hope you're right, brother. I really do. I think that's the smarter move, is to not cut rates until next year. But again, it's an election year. He's going to have pressure too. And so we're probably cutting. Unfortunately, we're probably cutting. The NASDAQ getting destroyed today? No, I don't think so. The NASDAQ's green, no? Let me see. All right, so there's the NASDAQ. I mean, the NASDAQ's very green on the day. If you look at like a 15-minute chart, here's the day today alone, right? So this is today. This is the full day today. So NASDAQ's pretty strong. I mean, it's pulling back now. A lot of the time we get choppiness ahead of these big FOMC meetings and stuff. So, we might get choppiness. I don't know. I do know that I usually like to target choppiness for my trading strategy. And so part of me wants to buy this up, but I don't know. I think it's pie. Again, do me a favor, hit that like button. We got about 500 people here already. We still got 30 minutes before the FOMC decision. Hit the like button, hit the subscribe button. Help me get over 100 likes if we can. Wait, is there a new Pie movie coming out? Yeah. All right, so again, the NASDAQ now falling a little bit short term. Perspective is everything, though, from time frames, because, if you zoom in on the NASDAQ, this looks really weak, but if you zoom out and look at just the day alone, NASDAQ is still up a ton. Still got a long way to go, but again, it is the FOMC day. We, a lot of the time, do get choppiness, so we'll see what happens. All right, chat. Let me look at the poll, what the poll looks like here. So again, we got about 600 votes there. 37% of people are expecting a cut today. I mean, listen, it's not outside the realm of possibility. It's just super unlikely. So I don't know whether we're going to cut. I'm not going to make a bold 3% probability bet on the Fed cutting rates. I just don't think it's going to happen. What I will say is that typically if we have something super outside the realm, or within the realm of possibility, but not very likely, if it happens, the market's going to be wildly influenced by it. We're going to have big reactions, big movement in the stock market if it does happen. So again, we'll see. But yeah, if it does happen, what do you guys think the market will do? If the Fed does choose to cut rates, do you think the market will go up, down, or sideways? Let me know. Dump, pre-decision, pump, post-decision. Yeah. What do you think is going to happen in between the rate decision of most likely a pause and the FOMC meeting? That's another big question. I don't know. Now remember, the FOMC decision is at 2 p.m. today. So 2 p.m. today. So we got a countdown. You can see the timer in the top left. Gold still getting pretty close to highs, rejecting at this double top here for gold. How predictable is trading gold? I'm not a big gold trader, but I've thought about learning. A lot of people trade gold religiously. How predictable is the price action for technicals in gold? I know you can trade gold in both futures and forex as well, right? So if Bitcoin should go, I'm not sure about the stock market. Where's Bitcoin at today, too, leading into all this stuff? So Bitcoin all the way at 67,000, 6,700, or 67,000. So Bitcoin rising a little bit, but again, pretty choppy. Slightly green trend in it. Slightly green trend in it. Hi, mate. What's up, B? How does the rate cut affect markets? I'm not sure. I think it'll scare the market if the Fed chooses to do one out of nowhere like this when it's super improbable and unlikely. I think it'll scare the market more and probably cause a negative response. You know, I mean, real estate will be happy. It'll start lowering interest rates for people, but short term, I think it's going to scare the market because they're going to assume that if the Fed had to cut rates much earlier than expected, then something might look really pessimistic for markets. You know. Tesla falling? Yeah, so Tesla currently at 230s. Market didn't crash the last 15 minutes. Again, most of the time the market is going to do this during FOMC days. Right? And so right now, you know, if the SPY is going like this and then goes like this, it's not a shock. It's actually most likely what we're going to get on FOMC days is choppy, neutral, sideways activity. It doesn't mean like it has to happen, but it's just most likely, you know. September rate cut. Yeah, you want to pay attention because the September rate cut is the big thing that is you just want to watch for it. It's a major thing. If we don't cut rates in September, the question is also how does the market respond to that too? Because if we don't cut rates in September, it signals inflation fears spiking up some too. So no matter what, it signals something that the Fed is fearing. If the Fed's fearing a recession, they're going to cut rates. If the Fed's, and that might cause a scary reaction in stocks. If the Fed is fearing inflation, they might maintain a really hawkish stance and, you know, ultimately keep interest rates high for as long as possible. We got somebody predicting that they're going to do it in March. They're going to keep rates the same and pause until March, and that might not be a bad decision. If they're going to do that, though, they might as well just raise rates and then wait a couple meetings and then lower them back instead of waiting 6 months to 8 months until March. But I don't know. Will gold buy if rate is cut? I have no idea. Viz. How do you deal with the wash sale rule trading stocks? The wash sale rule doesn't really mean anything, Enzo. Like, the wash sale rule, I mean, it means something. It just means that you can't write off two different directions of profit, right? So if I make $1,000 and I profit $1,000 going long, and then I lose $1,000 going short in the SPY, right? I'm really net green if it's both on the SPY, or I'm really net neutral. I can't write off the $1,000 that I lost and not mention anything about the $1,000 that I made and act like I'm really down $1,000 when I'm flat, right? That's what the wash sale rule protects the country from, I guess. I don't know who they're protecting from it, but that's what the goal is that you can't write off something that you're not really down or up on, if that makes sense, right? ARM earnings report today. Yeah, so today we have Meta and ARM, I believe, right? Let me see. So Meta earnings. Yeah, we're gonna do a poll. Does the Fed cut rates? Yes or no? So we got a Twitter poll live. All right. Not today. Meta will dump by 100. Doesn't matter if it missed or not. They will dump it. Meta and Apple will miss. Mark my words. No, Amazon earnings are tomorrow. Meta's today, right? So Meta earnings are this afternoon. ARM earnings, QCOM earnings, Carvana earnings are all this afternoon. Amazon and Apple earnings are tomorrow afternoon, right? So yeah. Market just turned. Yeah, the market's definitely down a little bit short term though. So yeah, the market's actually down, which is interesting. Market's starting to tank. But I think we're going to bounce right now, leading into the rate decision is my guess. Again, a lot of the time the market's flat. Market's pushed up a lot this morning. Now it's correcting a little bit. Still very green on the day. So still got a couple minutes left though. So again, time will tell. We'll see. Yeah, we're down about $100. We're down a couple $100, but we were down more earlier in the day. We got a huge bounce just now. All right, guys, we got about 700 people here. We got 15 minutes left. Will the Fed cut rates? What about the Dixie? How will the FOMC affect it? I'm not sure. We got the SPY, NASDAQ, and gold up. The dollar index is going to move inversely to the equities market usually. I would say that a rate cut will probably boost the dollar, is my guess, because it means cheaper access to money, and so that's beneficial for the dollar. At the same time, I think that there's a big chance that the Fed doesn't cut at all, and so I think the dollar index might go down from this report. If it is a pause, and if it cuts, the dollar index will spike. But again, I'm not 100%. We'll have to wait. Nvidia bounced it up a lot too. And again, I'm assuming we get choppy action for the rest of this. I'm gonna exit out of some stuff. I got a bunch of windows up right now. I should have been exiting out of stuff. I got too many windows up. My computer's going and working hard over here. All right, guys, 15 minutes before the rate decision. 15 minutes. Here's the graph again of rate decisions. Here's the federal funds rate. And this is what they've kept rates at for the last 5 years. The last year has been straight pauses, mostly flat. August is when we started pausing rates. So last year, about the same time as when we started pausing rates. Prior to that, we were rate hiking pretty aggressively leading into this. We've been maintaining it about 5.25 and 5.50. So again, we'll see. Looking out. All right, we got about 1,000 votes. 40% of people expecting a rate cut today. That's shocking to me, to be honest. That's shocking to me. I just can't imagine that we cut rates today. It's super unlikely too. It's gone anywhere between 10% likely and again, it's gone anywhere between 10% likelihood if we look at the CME Watch tool, and right now it's 2%. And I can refresh this just to be safe. Again, yeah, 2.1%. So just very unlikely, very improbable. Wishful thinking. Why does trading make me lose my hair? It's stressful. Stress does that. If Fed cuts today, all regional banks, travel, automobile will skyrocket. Yeah, for sure. If Fed cuts, I'll probably buy up bank stocks or something like that. Remember, I'm not an investment professional. I have no idea what I'm talking about. Might be wildly wrong about anything and everything I say. What happens to the yield curve? The yield curve is bonds, right? I would assume that price of bonds goes down and the yields go up because of increased competition. Yeah, but bonds generally benefit from rates. Price increases, yield and price relationship. So when interest rates are going down, the yield of the new bonds actually decrease. Sorry, not increase. Prices of existing bonds with higher yields rise. So it's good for bond prices, bad for yields. So it's good for the government, bad for us, basically. More supply of money to buy them is why that probably is. That makes sense. If Fed cuts rates, does the market go up or crashes? I don't know, man. I think if the Fed cut rates today, people are going to freak out and panic, you know? So if the Fed cuts today, I think people are going to panic and get scared and you know, it's going to be bad. Just arrived. I didn't get a notification. Oh, sorry, bro. Nvidia options looking bullish. Yeah, Nvidia up a lot this morning. Pulled back a little bit over the last couple minutes, but up a bunch this morning. Starting to rebound back too. Nvidia is almost at 116s. If they do cut rates, I expect a bust today. They will hold rates and telegraph the next cut. Cutting a sticky 3% CPI would be... Yeah, I think we should not cut. Again, it's going to make inflation spike. CPI's high still versus what their goal is, at least. It's just a bad idea to cut. Again, do you think a cut is a good or bad thing right now? I'm assuming that most people are betting on a cut because they want a cut to happen. Maybe they're involved in real estate. Maybe they're involved in lending, and they want a cut to happen. Do you think a cut is a good or bad thing, chat? You think the news will keep the market bullish? Oof, I don't know. I want them to cut so the stock market could skyrocket. I think a cut is going to signal fear. It's going to signal fear by the Fed and make the market go down, most likely. You know? Yeah, Bitcoin's up. Bad, good. Cut is good for small caps, sure, but it's bad for everybody else. It's a lose-lose situation. Do you think that a recession would come when they cut rates? So when they cut rates, it's because they want to avoid a recession. It's not going to make a recession probabilities worse. It's because they want to avoid a recession. Now, a cut is better for avoiding a recession, but worse for inflation, right? So inflation will spike if they cut too much. And so if they do cut, I hope it's just one. But, you know, again, time will tell. We'll see. So is oil spiking because of geographic stuff? Yeah, it's definitely up today. It's up to 78. Yeah, so, again, oil is spiking up today. Generally, if you don't understand, guys, oil spikes whenever there's, like problems overseas, problems geopolitically. And so oil is spiking up today. Almost up to 80 bucks. It's at $78 a share. Property taxes are at record highs. Yeah, but I mean, property taxes... Depends on where you live. I'm in Texas. Property taxes suck here. You know, there's the whole no state income tax thing here in Texas, but it's a trap. They're like, oh, you don't have to pay state income tax, but pay 3% a year on your house. You know, what? I'd rather pay state income tax. No, I don't have any Tissot watches. Inflation will probably skyrocket by the end of the year and then extreme rate hikes next year. Yeah, I think that's what's going to happen if we cut rates too much. I guess the right decision is to wait for the Fed to make a decision. Yeah, that's probably... If you take a too big of a position right now ahead of this, it's just really, really risky, to be honest. Powell got mad and raised rates. Super unlikely. But possible, but just not very probable, you know. Hey, baby, I really gotta work right now. Okay, all right. Yeah, I'm gonna stream the full press conference as well, right? Full conference, everything. Yeah, I don't know which way the market's gonna go. What do you guys think? Markets will likely go down with a pause. I don't know. I don't think the market wants a cut. I think some people do, but most people understand a cut is toxic for us. Early cut, at least. We'll see, but I just don't think a cut's going to happen. Yeah, my portfolio is actually doing really nicely today. MU is better. Nike's almost... I'm almost green on my Nike position, which is good. Again, Meta, I'm actually green on. We got Meta earnings today, too. Again, Shopify is up there. All right, guys, we got 6 minutes, 6.5 minutes, about 7 minutes left. Yeah, the environmental protesters are always fun. So if you don't know the environmental protesters, every FOMC press conference meeting, every Powell speech, the protesters have been showing up when they can. You know, you can tell they can't show up to some meetings, but a lot of them, they're showing up and they are harassing him. You know, they are yelling things like, sometimes it even got him to curse, but so that'll be fun to see. Dude, make a ton buying Nvidia 115 calls yesterday. Yeah, Nvidia's up huge, but only a 50-cent margin there is a little risky, I think. But good luck. Hey, we got 5 minutes left, chat. 5 or 6 minutes left. Yeah. Starbucks Snap seems to be in a position for a huge pump. Majority of you here are bearish, so market is going to go rocket. I'm not really super bearish. I'm a pretty long-term bull. What about the Dow? So the minutes report's not today. Today's the FOMC meeting. All right, guys, we got 5 minutes. Rate cut helps everybody. Yeah, maybe. What do you think is going to happen to the market if it's going to stay flat as expected? I really don't know, to be honest. I really don't know. Yeah, the minutes is in 3 weeks from now. I'm ready for a bull market in 5 minutes. Hey, we'll see. Again, we got 4.5 minutes left, chat. We still got 1,400 people here watching live. Interest in the stock market's down ahead of the election, too. It's definitely different than how it used to be. So it's definitely different than how it used to be. Again, y'all hit that subscribe button, guys. We got 4 minutes left. 4 minutes. Should I put it in sub-only mode? I think I should. All right, we're going to throw it in sub-only mode if you haven't already. Hit the subscribe button ahead of this report. Remember, the press conference is going to be at... the accompanying press conference is going to be at 2:30. All right, so we got the FOMC decision in 4 minutes. The actual press conference is at 2:30. All right, you guys ready? Again, it's almost certain to be a pause, but the market's going to move heavily if it's not. We got gold up on the right side. We got the NASDAQ up in the middle, and we got the SPY up on the left. All right, chat, a couple minutes left. Mom's sketty. Weezneek. Arms are heavy. Vomit. Sweater. I'm nervous, chat. I'm nervous. We got 3 minutes. Yeah, we got a couple minutes left. Yeah, we'll have thousands of here when the actual number drops. It's at 2 p.m. though, chat. Remember, it's at 2 p.m. Let's see what we get. Again, we have had choppiness leading up to it. So the last, like, I would say most of the day right now on the NASDAQ's been flat. Here's the NASDAQ trend. Up, down, up, down, up, down. So here's the NASDAQ trend. Very flat, very choppy, very sideways. Hasn't done much. And again, it's a crazy report. This is a very important FOMC meeting. A very, very important one, you know. 49% of people think a cut is coming. It's got to be wrong, though. That's crazy. 59% of people think they don't cut rates today. Again, it's the closer likelihood is closer to like 2%, 3% chance of a cut. I mean, maybe I'll eat my words. Again, it's possible I eat my words. It's just not very likely I eat my words. Again, a rate is probably going to say sideways. The rates are probably going to be sideways. It's almost certainly going to be a pause in rates. It's almost certainly not going to be, yeah, it's almost certain not to cut. Sorry, I can't talk right now. All right, guys, we got a minute and a half left. Every time we get a Fed decision, all these people vote on something that's super unlikely. And then when they don't, they say manipulation, rigged. And it's like, well, maybe, but you can see what the likelihood is. And it's not super likely. All right, guys, we got about a minute left. A minute and a half left, really. A little bit, this is a little bit off. We actually have about a minute left. So I'm just gonna count it down myself. Yeah, the people telling people about a cut are usually just trying to scare people, I think, right? Cut's super unlikely. All right, Nvidia still sideways. 40 seconds, Chad, 40 seconds. We got 2,000 people here live. Get your last minute predictions out in chat. What do you guys think? Last minute predictions. 30 seconds. All right, I'm ready. All right, guys, 20 seconds. Ten seconds. Here we go. 5 seconds. 5, 4, 3, 2, 1. Let's watch the NASDAQ. Waiting, chat, waiting. Waiting here, we're refreshing. We're trying to get it up on screen. There it is. Maintain the target range. It's a pause. We are pausing interest rates. They're maintaining the target range, pausing rates. Again, this is a neutral reading, a neutral report. It's something in which the Fed is not raising interest rates. They are pausing rates. We told you guys that we were not going to cut rates. 40% of people that voted on this poll, guys. 40%. I'm going to end this poll right now. 40% of people voted on a cut. I don't mean to shame you guys, but why? Why would you ever think we're going to cut rates today? It's super unlikely. Again, we're going to, hopefully Powell's smart and they keep rates elevated for as long as we can. We don't need lower interest rates right now. They're not super high relative to the last 30 years. You know, they were up to 15, 20% for the federal funds rate. Short-term rates were up to 15 to 20% in the 80s. Like here's an actual graph of it all, right? So short-term rates, if you look at like the 80s were ridiculously high. Right now we're at 5.25, 5.5. So we're at 5.5 right now. It's not the end of the world. That's not super high interest, especially relative to the 80s or higher interest rate periods. You know, they were up to 10 in early 90s, 6.5, 7% in 2000s. So rates are not supposed to maintain super low always. It just causes inflation, and prices are unsustainable at those levels. They're just unsustainable. All right, guys. So again, we got the actual press conference coming soon. We got the actual press conference coming soon. Hopefully you guys are ready. We're going to cover the full press conference, the full Jerome Powell meeting. And yeah, again, the market hasn't, honestly, guys, what's really, really crazy, to be honest, the market has had such a neutral response to most things, man. The whole market's scared right now, dude. Everybody's interest in this are way low. And again, it's not just like, look, again, so we're maintaining the federal funds rate 5.5, 5.4. Rates left unchanged. Inflation remains, quote, somewhat elevated in this report is what they're saying here. So again, we'll put this up. And again, we're going to cover this full thing live. We'll do the entire press conference live as it happens in about 26 and a half minutes. But again, what's really shocking is not just the lack of interest in this decision. It's the market's response. The market has not reacted at all to the rate decision. Usually, like ahead of the big rate decision, some people are acting like, some people that are just trying to get your attention are like, oh, this is the biggest decision ever. Of course it's not. Like anybody that is telling you that the likelihood that we were going to cut rates today is high, again, has no idea what they are talking about. They have no idea what they're talking about if they thought they were literally going to cut rates today. They're trying to get views. They're trying to scare you. We were never going to cut rates today. Inflation is not under control enough to cut rates, and the economic reports are not bad enough to justify a rate cut, you know? So again, and the market has basically underreacted to this. We barely reacted to this decision. Like, look at this. The SPY has barely moved at all. Gold is down a little bit, but really interesting. We just don't have much of a reaction here, chat. I get it. People want to sensationalize things to get more attention, but like, again, I kept it easy and boring. We're probably going to pause today. We paused, you know. Powell, I don't know what Powell's stance is going to be. My guess is he's going to be somewhat dovish, talk about how good the economy's doing, but also talk about the progress that we've seen in inflation is my guess. He's going to talk about how, and maybe that'll make the market go up, right? But if it means that we're going to cut rates in September, I don't know if the market necessarily wants that, but I think that's the plan right now. So I think we cut next in a month, or in 6 weeks. You hope no rate cut because you don't hope stock crash. Well, yeah, I don't want the stock market to crash. That's water's wet, bro. You shouldn't want the stock market to crash either, bro. It's not about what I want or don't want. What I want Powell to maintain a high interest rate environment until next year, right? But that's not what he's going to do. He's going to cut in September probably, right? It's not about what I want or don't want. It's about whether you understand these decisions or whether you don't, right? And if you don't understand these decisions, you might be betting on things wildly outside of probabilities to happen. You know, if you understand these decisions, you'll know that in general, right, these analysts and votes on the CME Watch tool are highly accurate. They are almost never wrong here. And so if you don't think that this is probably going to happen, again, you don't watch enough of these. Again, it's highly probable that we're going to go with the outcome here. What does the outcome here show, chat? This is called the CME Watch tool. What the outcome here shows is that we got a 90% chance, at least at this point in time. Powell might completely change these probabilities, right? But at this point, we got a 90% shot that we're going to cut 25 basis points in September. 90% chance that we're going to cut 25 basis points in September. That's the biggest thing you want to look for. 90% shot, right? Now, whether we do that is going to depend on, it's going to be on the shoulders of Powell today. If Powell comes out, again, really hawkish, restrictive, doesn't like inflation, doesn't think the economy's weak, and maintains a high interest rate environment stance, then maybe we don't cut. Again, it might change those probabilities. But leading into this, again, it's not a shocker that we pause rates. Meta results matter more today than Powell? I don't think so. It's all subjective, right? So whether you think something matters today is very subjective, right? It's going to depend on you. But yeah. Yeah, so whether you think it's a good thing or bad thing, and whether you want high or low interest rates, none of that really matters, right? What matters the most here, chat, is what Powell says. You know, we paused. We knew we were going to pause. Again, this happens anytime we do what's expected. It's going to be anytime something is as polarized as this, I should say, right? So anytime we look like this, chat, in terms of probabilities, what the report is going to hinge on is going to be what Powell says. Whether Powell wants restriction in monetary policy, i.e. high interest rates, or whether Powell wants a loose interest rate environment, a less restrictive economy and stance. Less restrictive signals strength in real estate, low interest rate environment, more spending and a stronger economy, but ultimately worse inflationary problems, right? More restrictive signals a worse economy, a weaker economy, less people working, less people spending, high interest rate environment, right? And that's what you want to listen for with Powell. Either one, the stock market doesn't really hinge on either one. The stock market's kind of a different animal. But historically, the market reacts short term in a positive way, but long term in a negative way, if that makes sense. So I'm not sure if that's going to tell you anything or not, but that's generally what happens historically for this type of stuff. You know, again, the SPY all the way at 550s, very choppy. We'll see what Powell says. I wouldn't recommend necessarily trading this. I think it's incredibly risky to do, but yeah. I don't panic when the market goes down. I just buy the dip. Hey, good luck, Robert. I think dollar cost averaging is your friend in these moments, you know. Can you revisit stepwise on how to read that CME group? So again, you go to cmegroup.com/ you just type in CME FedWatch tool in Google and this will pop up. All right, so this is today's, right? Today, again, 98% chance of a pause by analysts, right? But in terms, these are pretty accurate. September, and again, we're going to wait and see what Powell says. Wait, is this for September? No, they're lagging a little bit. This site's lagging some, to be honest. Okay, September, again, looking at it, we actually have 92% of people expecting a cut in September. 25 basis point cut, 92%. 8.3% of people expect a 50 basis point cut in September. 0.1% of people expect a 75 basis point cut. And you could change each one. Like November, we could look at November. Again, my internet's lagging a little bit. 62% of people expecting a 50 basis point cut. Is that 50? Yeah, but 62% of people. Matter, or actually, I think this signals that we're going to do one rate cut, I think, and then yeah. So this means that people are expecting 2 rate cuts. They're expecting 25 basis points today, and then, or they're expecting 25 basis points in September, and then another 25 basis points in November is what this shows. I'm pretty sure. All right. So again, the market very flat. Gold pulling back. NASDAQ pulling back. We got 15 minutes, chat, before the FOMC decision and press conference. 15 minutes. SPY at 550s. NASDAQ at 19.4s. Gold all the way down to 2,300. How many think a rate increase is in the cards? When? Hey, thank you, my account. Buying TLT? Long-term bonds? Doesn't he usually just repeat on the report? Well, he does, but he also, the report is pretty mild. Like, he doesn't really say much in the report. Like, look, here's the report. It's more important because he's going to get interviewed, right? So, again, if we look at the FOMC calendar, the way you could find the report is you go down to here, you go to HTML. Recent indicators suggest economic activity has continued to expand. Solid pace, job gains have moderated. Unemployment rate has moved up but remains low. Inflation has eased over the past year but remains elevated. In recent months, there's been some further progress towards the committee's 2% inflation objective. This means there's optimism towards inflation getting better. They judge the risk to achieving employment inflation goals continue to move in better balance. The outlook is uncertain, attentive to the risks. In support of these goals, they're doing 5.5, maintaining, pausing rates. They don't expect it will be appropriate to reduce the target range until it is gained greater confidence that inflation is moving sustainably towards 2%. In addition, the committee will continue to reduce its holdings of treasury securities and agency debt. Basically, they're continuing quantitative tightening, which means they're reducing their balance sheet, and this is keeping interest rates high, if that makes sense, right? So again, the committee does not expect it will be appropriate to reduce the target range until it's gain greater confidence. They're going to continue reducing their holdings. Basically, they're going to continue quantitative tightening. Strongly committed to returning inflation to a 2% objective. This is a hawkish Fed. In assessing the appropriate stance, the committee will continue to monitor. So, yeah, hawkish Fed. You know, basically, they're not going to cut rates until things look better. And inflation terms, right? If inflation starts to look better, they might cut rates. But for now, it doesn't look like that. I'm for them keeping interest rates high. This is the Fed that I wanted. I wanted them to do this. You know, I wanted them to maintain high interest rates. I don't think we should cut. It's a bad move if we do. Hawkish is inflation fearing. Yes, correct. Hawkish, Connor, signals a more restrictive monetary policy. right? What do we mean by more restrictive? It means the Federal Reserve wants to maintain high interest rates. They do rate hikes. They maintain high interest rates. They try to restrict the economy in that way so that spending decreases and in turn inflation decreases, right? That's a restrictive, hawkish Fed. A dovish Fed is a loose interest rate Fed, a Fed that doesn't worry as much about inflation if it's under control and instead wants to stimulate the economy. We see a dovish Fed during big macroeconomic disasters like '08, like 2020. That's when we see a really dovish Fed, a loose Fed, because they're trying to lower interest rates, cause people to get more lending, cause spending to increase, and in turn stimulate the economy, save it from a recession and depression. So it's two sides of yeah. All right, Nvidia at 116, so Nvidia's still very high. AT&T pushing up too. This decision basically didn't influence anything, and the market hasn't moved. Chat, stock market hasn't moved at all. Interesting for sure, man. It's weird, you know. All right, the press conference starts pretty soon, chat. So again, we got a timer up. We got 15 minutes before the actual FOMC press conference. Is there any real substantial correlation between dovish and hawkish versus periods of growth outperformance versus value? Define periods of growth outperformance and value more economically, because the stock market and the economy it's a different animal. They're different animals. Profit booking on rate cuts, its liquidity comes to banks for rolling money. Yeah, banks are going to benefit from lower rates. The economy might benefit. More people are going to have access to lending. Businesses might grow and earn more money and stuff like that. But again, the real issue is that it's going to cause inflation to spike up more, right? So that's why the Fed, if inflation wasn't a problem, we would always have low interest rates, because low interest rates are good for everybody. Everybody can buy more houses. Banks benefit from it. You know, people like low interest rates better than worse, better than high interest rate environments. But again, the problem is inflation. Inflation gets worse if we maintain that for too long. So how do we know if we're going into inflation, high or low interest rates? High. Or low interest rates will cause inflation. I mean, billionaire. High interest rates will push down inflation. That's the goal. That's why the Fed is hawkish right now, because they're still fearing inflation. They want inflation to hit their 2% target. And when they say 2%, they're referencing PCE, the Personal Consumption Expenditure Index, what dropped last Friday. And so here is a PCE graph. You can look at like trading economics. Here's PCE, right? Last time we showed up at 2.6% for June. This dropped last Friday, I believe. This is the 2%. So we're getting better, right? We're moving back down. Here's the last few months. We're moving back down. But again, we still want to hit 2% target PCE wise. CPI is the other one. That drops in 2 weeks from now. If you look at the CPI inflation graph, the consequence of a low interest rate environment, guys, is inflation spiking. That's what happens. If rates aren't cut in September, despite it being predicted, how do you think the market will react? I think the market will react neutrally and just let the stock market go do its thing. I think if cuts happen early or outside of expected, I think, I don't know. I think it has the chance to jolt the market. Maybe good, maybe bad. I'm really not sure. If we don't cut rates next month, even though it's expected, I don't know. I think what I would do is I would wait for Powell to speak today. And then once Powell speaks, I would gauge Powell's sentiment and see what the expected outcome for September's rate decision is afterwards, and then use that. If we show up outside of that, we might get a brash reaction. But if we come in as expected, the market will probably do what it did today, which is nothing, All right, guys. All right, I'm going to switch my headphones out, get ready for the press conference. We are ready. Let's get ready here. So I'm going to put a couple of these up just to see which one is better, chat. Move this to the right. Again, we got about 10 minutes left. Put the SPY and the NASDAQ up down there. This should give it plenty of room. Yeah. All right. And then, let me put my headphones back in. And I'm going to also put another one up just to see which one's faster. Just in case. See what that looks like. Yeah, we got Powell speaking today. Again, we got about 11 minutes chat, 11 minutes until Powell speaks. Hopefully it's good. Hopefully he does something to benefit the market. I'm for it. Market's pushing up a lot ahead of it, though. So, you know, anything could ultimately happen here. We'll see. All right. Whew. All right, chat. So again, we're watching Nvidia is still up to 116s. So Nvidia is still making ridiculous moves. Yes, we are live. Yep, we're live. All right, watch the SPY. Again, we'll see what Powell says. 10 minutes left, Chad. 10 minutes left. Usually when the market is too high prior. Powell said not today. Yeah, I mean, a cut was never going to happen, though, Chad. That's the funny thing. It's like a cut is just super improbable. I'm going to do another poll. Do you think Powell is hawkish or dovish during his speech? I think that's a good question. Is he pushing for restriction in monetary policy or loose monetary policy? I think he's gonna. I think he sounded in the report. It sounded restricted. It sounded like he's gonna maintain restriction. Hopefully. Again, I think that's the move. Y'all can hear my headphones too. Correct. I just want to make sure you guys can hear me. All right, guys. SPY up to 551s here, so the market's still very, very strong. If we look at something like gold, right? Gold's still right around highs. We'll see what Powell does. Again, the market didn't really move. The market definitely moved less for this than it has a lot that I've seen historically. You know. You guys ready? Yeah, so I got a couple different windows up. I just want to see. Sometimes some of the different feeds are faster or earlier. I'm going to find the fastest one and put it up for you guys, regardless of where it is. So stick around. Again, SPY all the way up to 551s. Gold is at 2460s. Would y'all rather the SPY or the Q up on the chart while the meeting's going on? I'm in both SoFi and PayPal, and I've been in them for months. So, yeah, they're both green today. SoFi is definitely green. I covered SoFi's earnings earlier this week, on Monday, I think it was, maybe Tuesday. SoFi had a good day, up to 760s. I've been red in that one for a while too, so it's nice to see. We went from really bad high rates to him stopping the raise. Yeah. SPY, Q. Let me tally these up. 1, 2 for Q, 1 for SPY, 3 for Q, 4 for Q, 5 for Q, 3 for SPY, 4 for SPY. 6 for Q, 4 for SPY. Q, SPY. Dude, honestly, we're completely flat. It was 7 and 7. SPY versus Q. Participate in the chat. Would you rather up the SPY or Q up? I don't know. How would Bitcoin do in the speech? SPY, SPY, Q. All right, look. Would y'all rather the Q or gold up? Q or gold chart during the meeting? You know what? Look, y'all have convinced me. I'm just gonna put 3 charts up here. Q, Q, Q. Okay, yeah. We're gonna. Now we got people saying gold. I don't freaking know what y'all want. All right, there we go. Gold's the bottom chart. Or the Q's the middle. All right, there you go. Q's the middle. SPY's the top. Gold's the bottom. You're welcome. He's going to say the recent inflationary numbers have given us some confidence we are on the right path. However, we are not where we need to be. He is going to say, quote, this is exactly what he's going to say. I'll tell you what he's going to say at first. It's not about what he says at first, though. Like, he is going to say this. Recent indicators suggest economic activity has continued to expand at a solid pace. Job gains have moderated. The unemployment rate has moved up but remains low. Inflation has eased over the past year but remains somewhat elevated. In recent months, there's been some further progress towards the committee's 2% inflation objective. They seek to achieve maximum employment and inflation at the rate of 2% over the long run. They judge that the risks of achieving its employment and inflation goals continue to move into better balance. The economic outlook is uncertain and the committee is attentive to the risks on both sides. In supporting these goals, we decided to maintain the federal funds rate where we were and pause it. Rate cut people were dumb, is what he's going to say. That's what he's going to say, right? Maybe not that last part, but again, how could you think we were going to cut rates today? Anybody that watches economics knows we're not cutting rates today. Anybody that has a major channel that told you we're going to cut rates today has no idea what they're talking about. Again, I'm not being mean, I'm being honest. If you watch some big economic channel that told you that we were going to cut rates today, they have no idea what they're talking about. Anybody that understands it is going to know that we're going to pause today. We've gotten like years of FOMC decisions correct. We haven't been wrong once. And again, if somebody is watching and telling you that we're going to cut rates today, again, they have no idea what they're talking about. We got 5 minutes, chat. 5 minutes. Yeah, I'm going to live stream Meta earnings as well. Also, what color is Powell's tie going to be today? Nah, he's going to call rate people dumb. Maybe. Channel is doing good. Yeah, no, channel's doing great, you know. What I figured out is that views are still good. Like, our views are basically the same, right? Something happened with, like, the reader of views. And it's not just me. This has happened to every single major economic, finance, and YouTube channel, right? So it's definitely not just me. It's happened to everybody. We still got thousands of people here live, and we had over 2,000 when the report came out. So, you know, we're doing fine. This stream already alone has, in terms of, like, viewership, has almost 20,000 views already, right? So, like, it's probably the counter is what I'm guessing has been weird the last couple weeks. Since the CrowdStrike Microsoft thing, it's been off. It affected a lot of channels. Some of channels it affected really, really bad, you know? But again, I think it's the counter as well. Anyways. Can you tell about a genuine indicator? Yeah, I like the volume weighted average price. I like the 200 EMA. I like, yeah, I like the VWAP, the 200 EMA. Engulfing candles I like a lot. You know, there's a lot of them. Hey, what's up, Steven? Thanks, bro. Is he gonna hawk 2-ish? Silk. If a green tie we put up, I'm gonna go with purple tie. Powell is either gonna have a purple tie or it's gonna be a gray tie. Purple or gray is my guess, right? Look, I'm gonna channel my inner purple tie, gray tie. One of those two. Something's telling me purple, but it might be gray as well. 50 Shades of Gray. Anyways. Fibonacci's. No cut till 2025. Let's go. I'm for it. Honestly, I hope we don't cut until 2025, dude. Again, I genuinely hope we don't cut until next year. I don't think we're going to go like that. I don't think it's going to go like that, but I hope we do. Like, I genuinely wish we did go like that. Powell watches his stream, can't decide. Do a poll. No, I'm going to keep the poll we got. We got 900 votes on the poll already. 56% are hawkish, 44% think Powell's going to be dovish. And so again, we're going to see what happens. We got a minute and a half. Chat. If you didn't swing calls in today. Matthew, come on now, bro. All right, guys, 1 minute. Powell would be good to add if he came out and said we like rates. Yeah, I'm not mad at Powell. I'm just disappointed, you know. I don't think Powell's mad at the economy. I think he's just disappointed. You know, we got 1 minute left, chat. Disappointed in inflation. We got 1 minute before the actual press conference. Again, we got multiple different feeds here. I'm gonna get you guys the fastest one. You're welcome. Do me a favor though for looking out for y'all and hit the subscribe button. Chat, hit the notification bell. I appreciate it. And again, we're gonna stream the entire thing live. Y'all can hear the music, correct? I just want to be sure y'all can hear the music. What color will this tie be? Yellow tie. Again, y'all can hear the music, right? We're waiting. They haven't started the press conference yet on either feed. Also, hit the live button. Hit the notification bell. Once the stream starts, just let me know if you can hear it well. Just say yes or no, so I know if you can hear it well. Chat. But again, they haven't started yet. We're waiting. We're live. I'm gonna mute the music as long as y'all can confirm y'all can hear it, which y'all do. I'm gonna turn the music off. Unmute this. Which is terrible hold music. I told you I'm going to give you the fastest stream. This one's faster.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period. The growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Now, these are big, guys. The questions are very important.
Gina Smilek from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Good question.
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
I think they're going to cut in September.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut, and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly, or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market, too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates, and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have two mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this, and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates, and I think this is how we balance them. It's a rough balance, but it does feel like, again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, and we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now of thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen significant movement in the labor market, And, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this, we raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market has, I think, unemployment was in the threes, mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have, we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this, we think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most rate, you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that we're, to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report and, frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about, if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months we're reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably down to 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, you know, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. So, you know, we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just it, and then how is that affecting the outlook and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in and so much happening between now and the September meeting, and we'll make a judgment.
Edward.
Thank you, Mr. Chairman. Edward Lawrence, of Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, you know, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So you know, but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports, last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, you know, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We said that we pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got another quarter that is good, and you know, we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have we had a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But you know, there was a real discussion back and forth of what the case would be for moving at this meeting. You know, a strong majority supported not moving at this meeting. That was a strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney. Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction, whereas, I mean, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation, rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restricted. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. I mean, just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria. Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So, again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So, again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more. If it starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown of the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the nonprofit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness, and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter, so it's just hard to measure economic activity. There are a lot of. It's just difficult to do. So I look at both. Yeah, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary. But we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically, we have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. we're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we've felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean.
Hello, Jean Young with MNI Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, the way the meeting is set up, the first day, there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go-around. And then this morning, we have the monetary policy go-around. And I think in people's economic go-around and in their monetary policy go-around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so, in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming
Yes.
inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question, that is the case. That, as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, We had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off any more for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market. So that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see, which way the economy heads, and I think if we are to respond to weakness, we're certainly, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and, a good labor market and inflation coming down.
Greg.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we have to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And, when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction function, that's a long time, discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things, the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
All right, guys, so that is the FOMC meeting. Honestly, the market has reacted very positively to this. If we look at all the markets, like here's the SPY on the left side. It's up a huge amount. It's up to 552s. The Q is up. Gold is getting pretty close to lifetime highs. Gold lifetime highs are at 24, like roughly just under 2,500 at 2488 is gold's lifetime high. Again, like I'm going to tell you this. If whoever you watch, whichever page you watch, and again, this whole meeting was pretty underwhelming, right? I think the move happened the few hours preceding the meeting. But if your analyst guy told you that we were going to cut rates today, again, I'm here to tell you they do not know what they're talking about. Like, how are we able to get it exactly right? Yet there, for whatever reason, for years, we haven't missed one. Right. And again, it goes back to what I told you. The analysts know what they're talking about. Like if people, for whatever reason, want to be contrarian, they want to be shock value, and they want to tell all these people that like we're going to cut rates today and really mix it up. And, they're just trying to get views. Like, be smart. Like, you shouldn't like to be manipulated. And either those people, there's two options there. They either have no idea what they're talking about. If they genuinely think we're going to cut rates today, they just don't understand economics. Like, they don't understand the Fed. They don't understand probabilities by the Federal Reserve in terms of their decisions. I know a lot of people are still calling it rate hikes whenever we haven't raised rates in years, or in about a year. I think the last time was almost exactly a year ago. But they're still calling it rate hikes universally. Again, in the end, today we paused interest rates. We didn't do anything. We're still at 5.5 basically right now for the federal funds target range, 5.5. 5.25% to 5.5%. That's short-term interest rates. Eventually, those are going to trickle into long-term rates. So we'll see if mortgage rates are going to start coming down if we do cut in September. I think if it's just one cut, it's not the end of the world. Like, it could be worse if it's just one cut. I got the tie color exactly right. Listen, purple tie. I said purple tie. We got a purple freaking tie. But with that said, we also got the decision rate. I'm pretty sure we're going to cut rates in September. I mean, I think this is the one thing that's overwhelmingly clear, I think, from this meeting. Even though Powell was trying to stay neutral, he's trying to stay vague, he's trying to stay ambiguous, I think we're almost certainly going to cut rates in September unless we have massive, like, dangerous spikes in inflation data. If we get bad, like, dangerous spikes in inflation data, then that's a different story. Then there's a chance that we don't cut rates, of course, and that then there's a chance that we don't cut rates and like the market stays the same. I don't know. Again, I'm here to tell you we're almost certainly not going to cut rates. I was here to tell you we almost certainly weren't going to cut rates today, and we didn't. What I'll say is we'll probably cut rates. It's overwhelmingly probable that we're going to cut rates next month, or not next month, in September, so in 6 weeks from now. So in 6 weeks from now, we're going to cut rates, right? Unless inflation data. I would say if PCE data spikes up to like 3.5, 3.6%. What's PCE right now? PCE is 2.5%. If PCE spikes up to 3% over the next 6 weeks, if CPI is way higher than expected, PCE is way higher than expected, then the Fed might not cut rates. But outside of that, it's pretty probable that we're going to cut rates next month in September. So, again, we'll see what happens. If you haven't already, check out my sponsor, Apex, one of the most legit funded programs in the world. They give you a demo, and they test your skill with a demo account first. If you want to learn to day trade, do not risk thousands of dollars of your own money putting it into stocks, trying to day trade penny stocks or some rookie thing that almost certainly is not going to be profitable for you. Most people make money selling courses on that stuff. Just marketing can be toxic. Instead, try a funded account program. Most day traders lose. And so in a funded account program, they're going to give you a demo. They're going to test your skill first before you're risking tons of money. If you fail that, then you only lose what you pay for. The base one's $35 if you use my coupon coded link. And again, they pay out millions. They give you a demo, test your skill. If you can make $1,500 in profit on the base one without losing $1,500 first or following their rules, it comes with real-time data as well, which is going to cost about $35 if you paid for it outside of these funded account programs. But if you pass it, again, you get $25K in funding, 90% split, very similar to putting the money up yourself. If you fail, you lose $35 instead of $5 grand, $6 grand, $10 grand. A lot of people lose thousands and thousands of dollars. It just doesn't make sense. And in the futures market, you can day trade the S&P, the NASDAQ, gold, a lot of cool stuff. Again, if you want to check it out, here's my link. You just got to use my coupon code BT, beginner trading, BT. There's the link. They're a sponsor of mine, though, so they pay me money. I am biased because of that, though. They pay me money. I'm biased because they pay me money. You would be biased, too, if they paid you money. And understand CFTC 4.41, hypothetical or simulated performance have limitations. I have no idea what I'm talking about sometimes, and I might be wildly wrong about anything and everything I say. Don't copy me. I'm not an investment professional, and if you lose, it's your own fault. With that said, we're about to cover Meta earnings. Chat, Meta streams their earnings report live very, very soon. Their earnings report comes out in about 30 minutes, so stick around. Don't go anywhere. We're going to cover Meta earnings live like we always do here. And before we end it, guys, what is your expectations for next month? Do you think we cut rates? I think it's possible. I think it's highly probable as long as we don't have inflation spike, just like Powell says. You know, and you'll hear me, like, the reason I can gauge Powell's decisions is because he sounds very similar to what I sound like. You know, if it was me, I wouldn't cut rates. But, you know, yeah. If it was me, I wouldn't necessarily cut rates, but I'm okay with just one rate cut. If we just cut once, fine, right? I'm going to be upset if we do all these huge, ridiculous... yeah, I'm going to be bummed out if we do these ridiculously large rate cuts that are just going to drag interest rates down and spending, spikes aggressively. It just doesn't make any sense to me. Anyways, we got Meta earnings coming up soon. Meta earnings dropping very soon. Yep. So stick around. Again, we're going to cover Meta earnings live as they happen. Also, guys, let me put this up. Let me make sure this is... Yeah, so we got Meta earnings live. Let me set this up, though. And again, don't go anywhere as soon as we close the stream. Market's starting to pull back a little bit. Gold's starting to bounce some. Let me see. I'd rather buy Nvidia. No cut. Market can sell. Thoughts on Meta after earnings. What's up, Blaze? Set. Yes, cut for September. Too many rules. Pass my challenge with the eyes closed. Hey, good luck, dude. Are you covering Riot earnings? Yeah, we'll cover all of them for sure. Randomly found your page today. Subbing now. Good-ish. Hey, thanks, bro. Appreciate everybody joining me. Yeah. So, Meta earnings today. Let's get ready here. My headphones should make it work all the way until the end of it, but we'll see. What are y'all's predictions for Meta earnings, I guess? Meta has Q2 earnings dropping in about 25, 30 minutes. So what do you guys think about Meta earnings? Meta Q2 earnings is what this is going to be. Is it Meta Q2? And we also have a bunch of other ones, to be honest, after the close. Like, we have... what else do we have after the close? We've got Meta, ARM, QCOM, massive earnings, Carvana, Riot, Etsy, Paycom, a bunch of other big ones. So we got a bunch of them, too. So again, stick around. You won't have to go anywhere. As soon as we close this stream, it'll immediately bring you to the Meta earnings call, or the Meta earnings report stream, which is going to start pretty soon as we speak. Make sure we're good there. Let me make sure we redirect. There we go. All right. Yeah, so as soon as we close the stream, we're going to redirect to the Meta earnings stream. If it doesn't bring you there for whatever reason here, chat, I will put this up so you can check it out. Here is the Meta earnings stream. Guidance. Yeah, guidance is always the most important. Same as Pinterest. Undervalued company, great PE ratio. Yeah, the PE ratio is pretty... I mean, what is it, like 30, 35 for Meta? We're covering all of them. Mir. We're covering all of those, all the big ones. Again, I'm going to see you guys over there. Again, Meta earnings, big report. We'll see what this looks like. Again, as soon as we start the stream, it should immediately pivot you to the Meta earnings call. If it doesn't, let me make sure. Again, there's the link in chat. Check it out. Make sure my redirect is working. Yep. All right, cool. All right. We're starting that stream up right now.